So this is JAVIII.fx from JT Empire. Welcome JT Empire family to your first technical class. This is your technical forex class PowerPoint presentation. Alright, so in this class we're going to talk about bulls, bears, trends, market geometry, structure, price action, support and resistance, pattern, key terms, key technical forex terms, indicator, Fibonacci, entries and exit, and also a confirmation guide. So firstly, bulls and bears. You hear this a lot in foreign exchange trading. A market is said to be bullish when it is in an uptrend, and a market is said to be bearish when it is a downtrend. No, bulls and bears come from the perspective of how the animals actually attack. So a bull attacks from downwards up, and a bear attacks by extending its arm upwards and then pushing it downward to attack its prey. So trends, uptrend, right? You should always aim to buy in an uptrend, right? The market moves in a series of high highs and high lows, right? As you can see right here, this is the uptrend. We have a higher high, higher low. Higher high, the higher high is higher than the previous high. That's why it's considered a higher high. And then we have a higher low. The higher low is higher than the previous low, so it's considered a higher low. Then you have a higher high again. You get the gist, right? Downtrend now, you always aim to sell in a downtrend. So this is where the market creates a series of lower lows and lower highs. So we have lower low right here. You have a lower high. Then we have a lower low. The lower low is lower than the previous low, so it's considered a lower low. Then we have a lower high, lower than the previous high. Then the market go on form the market creates a lower low, right? Elliott waves. This can also be called the three-wave pattern or the 5-point pattern. This is something that was observed and called Elliott wave by the person who actually discovered it. Right? It's where the market moves and create waves. The first wave is usually small, the second wave is usually larger than the first wave, and then the third wave would be the overall coming down of the market, right? So I also call it the 5 points, where I have 1, 2, 3, 4, 5 points. You can go on the chart and identify this for yourself after this video. Market geometry. There are a lot of these, right? So we're going to look at two: the inverted head and shoulder and the head and shoulder. Right? So for the head and shoulder, we have an uptrend. These are both of these are reversal pattern, reversal market geometry. So we have an uptrend, then the market creates a left shoulder, then it comes down, then then the market creates a head, then the market comes down again, creates a neckline, then we have the right shoulder of the market, then the market push down, switch to a downtrend. That's the head and shoulder for you guys. The inverted head and shoulder, or the inverse, now is where the market is in a downtrend, creates a left shoulder, comes up, then it goes down again, creates a head, then it comes up, creates a neckline, then comes down, creates a right shoulder, and then it reverses to an uptrend. Now, price action and market structure. These are two major concepts when it comes down to technical analysis. Now, as retail traders, we consider market structure to be the king of the market, right? This gives us the overall bias of the chart. It gives us indication of the trend in the market is changing. Right? It includes support, resistance, trend, market geometry like head and shoulders, etc. Right? The price action now is a queen. They go together. This gives us entry levels, allows us to mark off key levels. It gives indication that the market is changing trend. It involves candlestick formation and patterns. Also gives the momentum of the market. Support and resistance. Support and resistance, they are a part of market structure, right? Support, this is viewed as a low level within the chart where price made a previous rejection. This is called a floor. When price breaks the support, it then becomes a new resistance. Now you can picture the support as your floor. You're walking in your house, it is keeping you up. So it's essentially keeping price up. That's why it's called a support. Now, resistance, this is a high level within a chart where price made a previous rejection. This is otherwise known as the roof or the ceiling. When price breaks this resistance level, then it becomes a new level of support. You can picture your ceiling in your house. Now, if you could jump and touch your ceiling, it will definitely push you back down. So resistance is actually keeping price downwards. And if in the event that you could jump through your ceiling, you will then be on the roof of your house, which will then keep you upward. So that resistance, which is your ceiling, will then be support for you if you then break through and is standing on the roof of your house, right? So you can look at it from that view. Now, support and resistance using some sort of price movement now. So as you can see, when prices at this level of support right here, right, it was rejected. Price could not go below that. Therefore, it heads to the resistance, right? When price breaks that resistance right here, it now becomes a support for price. So it's above it. I know it's supporting price. Alright, so there are a lot of key patterns when it comes down to the geometry, right? You have the cup and handle, falling wedge, rising wedge, double bottom, triple top, triple bottom, double top, etc., etc., etc. You have the flag, pennant, rectangle. All of these are different type of geometric patterns that you will identify on a chart. Now, you should by now receive something called a forex cheat sheet. It should either be under this video or in your email, right? You can then look and to see these formations, right? And then you can then put it beside the chart and look at the chart to see if you can find them. Right, key terms when it comes on to technical analysis. Now, first let's look at impulse. Now, impulse is where the market is pushing in high momentum, when the market is pushing in high momentum in the direction of the trend. Right, so right now over here we have an option. The market make that impulse coming all the way up here. So this is the impulse of the market. Then over here we could consider this an impulse again when the market is going up again. Pullback now is deemed where you see the market has a resistance before and it breaks above it and then comes back to test that level. Or the market has a support, it breaks that support and comes back to test it as a resistance. So right here we identify this as a pullback because the market was below the level and it comes above. And now the pullback would be when the market comes back to test the level. This is the pullback. Right? And we could see another pullback right here. The market breaks the resistance and is above now, comes back to test it as a support. That's a pullback, right? Now, retest is when the market goes to test a level and then it comes back to test to see if it can potentially break or it will be rejected. And right here we could find retest right here, retest right here, retest right here. And of course it's not test, it is retest because it previously tested the level, so it's retesting it. Right? We could see multiple retesting of these support and resistance, or I could say key levels of structure. Now, let's look at a correction. The correction now, when we look at foreign exchange trading, is when the market make an impulse in a direction. The correction will be if the market comes back in the opposite direction to take out all the previous moves, or if not all, most of it. So right here we had movement to the upside, right? That impulse right here, the market comes back all the way down. Pretty much the full move of this impulse going up. The market came down equally to the amount of upward movement we have on the left side. That's a correction. That's where the market corrects itself. A retracement now would be a percentage of an impulse. So it's not taking the full move of the market, right? Retracement. It is coming back, let's say 50%, 60%, etc. So this we have an impulse right here, right? Remember, this is the impulse. The retracement would be when the market comes back right here. This is considered the retracement. So you have the impulse and then the market comes back a percentage of the impulse. And you know waves, market move in waves a lot of the time. You know wave, if you think of an ocean, up down movement and like something like this, the market constantly moving waves. Now Fibonacci retracement. Fibonacci retracement tool helps to indicate future price movement through retracement levels. Right? When in a trending market, it helps us to show where price is traded at a fair value. The golden Fibonacci retracement level would be 61.8. 71% level would be if you're trading synthetic indices. But I like to also identify or highlight the 88% level because I see whereas this is a very strong level. Right? Over here, we can see a picture of the Fibonacci retracement tool, and it shows you different levels. Further down this course, I will show you how to use the Fibonacci retracement tool. Indicators. No, I don't use any other indicators outside of these. No, I use a session indicator. This highlights areas of price to show the difference in the session data. So this will highlight the New York session, shows me all the price movement that took place in New York, shows me all the price movement that takes place in London, etc. I use this indicator on TradingView. The RSI, this is a relative strength index. This is a momentum indicator. It shows magnitude of recent price changes to evaluate overbought and oversold levels. So this also shows you areas where the market could potentially reverse. The awesome oscillator is similar to the RSI, right? It shows you overbought and oversold level, and it's also a momentum sort of indicator. Both of these are oscillators, right? Which shows you where the market could potentially reverse, right? The moving average now, this is a line that flows alongside price on a main chart. This acts as a dynamic support and resistance for price, right? It's the average movement of each candle and it's following price. Entries and exits, very important. We generally enter in market where there's a pullback, retracement, break, and retest of trend, etc. We exit at levels where there are chances that the market might switch or reverse to the trend that is opposite to our order. It should be OUR. Our buy entries or buy orders should be on a support, and our exit for our buy positions should be at a resistance. On the opposite, and our sell orders or sell entries should be at a resistance, and our take profit or our exit should be at a support. Confirmation toolkit. Now, these are questions that you should ask yourself before entering any trade. Now, you need to ask yourself, did the market break previous higher low, trend, support, resistance, structure on a whole? Did the market exhaust, overbought or oversold? Are there any geometric patterns that are seen? Head and shoulder, inverted head and shoulder, pennant, flag, etc. What candlestick patterns are you seeing? Morning star, evening star, marbozo, doji, etc. Are there any rejections to key levels? These are questions that you should be asking yourself when you're analyzing before you enter any trade. That said, any questions you have, comment down below. Send me a message, email, or talk in the group and ask the questions. With that said, this is JAVII.fx. Peace.